Dear investors, in today's video I will talk about investment styles, and I will give you also examples for the investment styles. So basically I will talk about value investment and growth investment. Some growth investors says value investment sucks, and some value investors says the opposite. But basically I will show in my video, or prove in my video, that we can apply both styles in our investments, and we can be successful. You can see on the picture the guy is thinking about which way is better, value investing or growth investing, and he cannot decide. So he say that everything sucks, I cannot decide, I rather not invest. But basically there is certain characters of value investing and certain characters of growth investing. I will show these characters in this quick chart, X-Mine chart. So we can characterize growth investment like a high growth rate. So the company's growth rate every year, it's maybe 30% or even higher. Often these companies has high price per earning ratios, or even have no earnings, so we can use price per sales, but is also high. And it's also next big thing. So artificial intelligence, some biotech company, so many different fields, or delivery companies, or others systems. So everything which is new and big things, so disruptive, like some investors using. And this company seems to have a bright future. And there are some certain other characters, but these are the main characters of growth investment. And what is the characters of value investing? So basically it's a low PE company, so low price per earning, currently worth more than the market values, often pays dividend, and basically this is boring companies. These are established companies which are can generate substantial cash, but there is no big things in the future, and it's not that exciting. Some typical examples about growth and value stocks. You can see on this chart Netflix, Amazon, which are already generating a lot of money, but they are growing heavily, even though their size is huge. Uber is not generating a lot of money, but has a huge potential with autonomous driving, and everybody is excited about it. And Spotify, yeah, Tesla, of course, and there is other example, Snapchat. So there are many such kind of companies which has a bright potential future, and also high growth potential. But if this potential doesn't materialize, then the stock price can go in a low territory. And value stocks like Coca-Cola, which are generating substantial cash flow, but it's a boring company with low P or price per earning ratio, and AT&T, Intel, Visa, McDonald's, and Procter and Gamble. So these are just examples, but in the next slides I will show you a great opportunity in the today's environment to invest in one growth stock and one value stock. A typical example of value investing or value stock in the current environment is Philip Morris International. So nobody like tobacco industry, and nobody likes to, or many people don't like to invest in tobacco stocks, but company generate a lot of cash, but the market values the company at a low price per earning ratio. However, this company is innovating in new technologies and more healthy tobacco products. So like IQ OS, it's already on the market, and more people using this product. So the company has a great future. Company doesn't has to pay on marketing because it's not allowed. They can save this money. They can buy back shares. They can pay dividend, and in the meantime also the stock price is appreciating. So this is a great investment, value investing opportunity in the future. Let's take a look on the next one. The next one is Adobe. This is a growth story. So Adobe is in a software as a service industry. So they generate already substantial money, but growing heavily. So the company, so everyone likes a software as a service, and the company is growing 30% yearly, even though this is a big company. And this, because of this growth potential and this exciting market, the company has a high price per earning ratio. But it's a good investment because if this growth materialize in the next years, then it's proved to be even more expensive stock, or you can gain a lot of profit if you invest today. But this growth potential has to be materialized. How should we define the value of the company? So our friend Warren Buffett knows much more about investment, and he defines in a simple term: intrinsic value can be defined simple. It is the discounted value of the cash that can be taken out of a business during its remaining life. It seems to be so easy, but it's not that easy in my point of view, because the future is foggy, but we can always see the next step clearly. So if we have a growth story, we can see that the company is growing now, but it's unsure that how much cash it will generate in the next 10-20 years. But this is the beauty of investment. It's never sure, but you have to predict somehow the future. So I will show you in a simple Excel file how to predict the future. It's, even though it's not clear, but we have still better chance than not to predict somehow the future. Calculate intrinsic value. I created a discounted cash flow calculation table, and we can check for example the valuation of Adobe, and you can see from the chart the current share price is 622, and current earning is 12, and the 5 years growth is 20, and 5 to 10 years is also 20. This is I calculated, I guessed basically, and the discount rate is 10. The terminal multiple is 40. This is the most optimistic calculation, and with that the share price can be 1346. If we are less optimistic, the company will grow 15% and 20% from 5 to 10 years, and the discount rate is much lower, 30. Then we are at 861. But if the company doesn't perform well, the growth rate is only 30%, and from the 5 to 10 years is only 7%, and terminal multiple is going down, you can end up with 50% of your money that you invested. But if you give a probability for 40 for the best case, and 30 for the normal case, and 30 for the worst case, we end up with 900 US dollar, which can be a 50% upside in case of Adobe. So let's check Philip Morris. If we go back to our summary slide, we can see Philip Morris is here. So the current share price is a little bit higher, around 100. This valuation was in May, and the growth rate is 10%. Discount rate is 7% in this case, because I expected less from Philip Morris. But this is, if the best case happens, we can double our share price or our investment. If it doesn't happen, the company only grows 6%, then still gain a little bit money. And if nothing happens, basically we end up only with the dividend, which is in this case around 5%. And with 40% for the best case and 30 for the normal case and 30 for the worst case, we can gain 50% of your money. What I wanted to prove with that, so even though it's a growth or value stock, we have to make calculation, have to make some prediction in the future. So basically we can gain from both investment substantial money. But if the worst case scenario happens with the value stock, we cannot lose money basically. But in case of Adobe, our share price can go lower if the growth trajectory doesn't happen. But if it happens, we can also gain much more. What else our friend can say about investments? So our friend is Warren Buffett. If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes. So basically both value and growth investments should be a long term investment. So if the stock price goes down, you should not panic. You should stick to your strategy, stick to your plan, and invest smartly. And I hope you learned something from my video and you enjoyed it. I wish you a great day.